Let's see. I
Good
just want to make sure
afternoon,
of one
everybody.
thing
Welcome
here.
back to the Opportunistic Trader. It is noon on November 1st, and we're joined now by Dave Floyd of Aspen Trading. Dave's been joining us over the past few weeks talking about technical analysis and different technical setups he's looking at, a lot of great observations. A lot's been going on. Dave, how are you?
Doing really well, Mike. Thanks for having me.
Yeah, absolutely. So as we just said, look, there's been no shortage of trading opportunities out there. You can pick your asset class, you can pick your instrument. Today's a very big FX day. It's funny, dollar's been bleeding higher the entire month of October, and then today we're seeing a pretty big reversal. Pound is up 1.6%, Aussie's up nearly 2%, Kiwi's up nearly 2%. I figured we'd start in the FX landscape and see what you're looking at technically and what you're thinking here.
Yeah, for sure. Well, again, thanks again for having me, both you and Larry and the rest of the folks over there. Yeah, for sure. FX is finally perked up quite a bit. I think it's going to be a debate now as to whether or not we move lower or if this is just simply a pullback within this rally that we've had in the dollar index. So I'm going to pull up my dollar index chart right here for some reason. Whenever I run this software, it always loads my charts slower, but give me a second. There it is. Um, to me, it's pretty darn clear where our line in the sand is for the dollar index. And the way I see it is as follows. We get much below 96.15, 96.09. I start to question whether or not this pullback is something a little bit more serious. Right now, as I have it labeled on my chart, I'm just looking at this as a pullback, and I'm expecting. Let me just clean this up just a touch here. I shouldn't say I'm expecting, because I don't really have an opinion on the dollar right here, one way or the other. But if I am bullish the dollar, we're going to want to see the dollar index hold in here in this 96.34 area, give or take, either side of it. We've already blown through, the first fib retracement at 96.54. So all we've really got left here at this point is, about 96.34, give or take. But for me, 96.15, 96.09, that's the key level. If we dip below there, then it's entirely possible. And of course, my chart locked up. Son of a, you know what? God, there we go. We drop below 96.15, 96.09, then it would be very reasonable to assume that this C wave, that what I believe as of right now, we are still in. But if we drop below that, that creates overlap in wave one, and it creates overlap in wave A, and that would suggest that this is actually the wave C top, and then we are going to be going down for an extended period. But again, this is scenario analysis at this point. I'm not making a bet one way or the other, because that's been pretty tricky in here. For me, FX has actually been very fruitful this week, but not in the dollar-based pairs. I've been trading the crosses. I've been short Euro Sterling and short Aussie Kiwi, and those trades are working out just fine, although Aussie Kiwi probably still has a little ways to go in terms of giving us the kick that we're looking for. But Euro Sterling's been a great trade. So I'm actually happier being in the non-dollar pairs. I'm in the crosses. So what we're
So
in right
how
now.
long of a term chart am I looking at right now? Is this a daily chart?
Now this is a 4-hour chart. So
This is a
what I'm.
4 hour chart of Euro Sterling, and we're seeing for the first time. So basically, for the better part of October, Euro Sterling was grinding higher, and then in the past, basically 48 hours, the pound has rebounded sharply, and so Euro Sterling lower.
Exactly, but the reason we got into this trade yesterday around 88.72, depending on your exact entry, my entry is 88.72. It was a pretty simple trade setup here. We had a three-wave correction lower, and then we rallied in this B wave to basically the 61.8% retracement of this move lower. That is typically where wave B's retrace to, 61.8% the length of A, and therefore when we started to get this move lower, seemed reasonable to me to get short, stops above the high. So I was risking about 60 pips, give or take, but plenty of downside. And the trade's gotten off to a much better start than I ever would have expected. I under an ideal circumstance, we'd be heading down towards 85.62. That's a monster move. Whether or not I'm in the trade for that long, that remains to be seen. But if you're looking at it from a classic Elliott wave perspective, that's what we would be looking at. Aussie Kiwi.
Yeah, Aussie Kiwi. I know you've spoken about that either 2 times ago or last time you were on. So how's that developing?
Yeah, I've been short this once before, and I'm short it again. Very simple. We'll go back to the initial analysis. I'll go back to a weekly chart. Again, a break lower from literally a 3-year consolidation. Wave 3, and then we had this triangle in wave 4. Looks as though we're breaking lower. I've been short this once within the last couple of weeks, as you correctly noted. I'm short again, short from not 107.57. We're short from 108.23. So basically, that's where we're trading at right now. 108.24 was the last. This was a painful move last night as we moved higher, but then we backed right off. So I'm still expecting prices to move lower in the days and weeks ahead. But again, sometimes conditions can change and you have to adjust. But that's how I see it as of now. You, like any trader, you reevaluate your thesis as new information comes across. And that's the one thing that's really, really key. You don't want to get hung up on the original thesis if something comes in and changes it. A lot of people do that. It's a major mistake. So Aussie Kiwi, it's moving lower, but I have to admit it's not moving lower. This move last night was, I don't want to say worrisome, but this is not what I would have expected. When I got short here, I was expecting prices to continue to move lower, not come all the way back to that previous swing high. Luckily, they fell out of bed, but again, not what I was expecting. And I'm just going to reload this chart real quick. But that's what I see in FX. And again, going back to the dollar index, I don't really want to be playing the dollar index pair or the dollar pairs until we get some clarity. You're just going to see my screen here for a second. But what I can tell you, and I'll show you once I get the charts back up, the one thing that I think is very interesting is that as of now, the opportunities, if the dollar is to break lower, are going to be in the Aussie dollar and in the Kiwi dollar. I'm not going to be looking to play euro because the Aussie and Kiwi dollar have responded much more favorably to the sell-off in the dollar index. Therefore, I just simply make the assumption that if they're leading the pack on this recent inflection point lower, it's logical to assume that they will continue to lead the pack. It doesn't mean that they will, but again, I'd rather be trading the one that's leading as opposed to the one that's lagging. And I'll show you a chart that hopefully I have it set up properly and it'll show it very clearly. Yeah, it does. Perfect. And bring this chart over here. This is simply a percent change chart. So what I'm doing is I'm plotting the dollar index here on the black line, and then I'm overlaying the major currency pairs. And I'm measuring the move from the recent high in the dollar index. Obviously, the dollar index has moved down about 0.75%, give or take, from that recent swing high on Halloween. So if we're looking for currencies to trade relative to the dollar, I want to be trading the ones that are moving more than the dollar index. So the obvious answer is Aussie and Kiwi. Dollars off by 0.75%. These are up by 1.6 to nearly 2%. Obviously, they move inversely to the dollar index. So again, if you are dollar bearish in here, this is where I'd be trading. Wouldn't be trying to trade dollar yen. I wouldn't be trying to trade dollar Canada because they're lagging. They're not keeping pace with the decline in the dollar index. So I find that to be a very helpful little guide when you get to inflection points in the market. Compare it to the benchmark, and that gives you a sense of where you should probably be focusing your attention.
Are you following dollar China much?
I do, but the dollar China is, it does its own thing. I don't get so hung up on what it's doing relative to other markets. I usually just trade that from a technical perspective.
Yeah, I was just pointing out it really seems like it's been a better almost index of the dollar. It's almost like a broader dollar basket right now. It's the best form of the dollar broader basket where, it's been moving straight up, but it was bleeding higher, the past 6 weeks. Not a big move. And then all of a sudden, today the dollar's weaker and it's,
Yeah.
moving lower. But retracing basically like your chart shows perfectly. I'm going back to here, like September 23rd. We've had a small percentage-wise move higher, but each day it was higher, 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 and then we're testing back. And it's interesting if you extend that trend line, we're getting pretty close to that inflection point. And today we had ISM, tomorrow we have non-farm payrolls. So for FX, we have yields here creeping back up today. Yields are a bit lower with the dollar lower, but with non-farm payroll tomorrow, it'll be interesting to keep an eye on as we approach these key levels in the dollar and in U.S. yields.
It will be, but I would say this is just my take. I might disagree with this one right here. I might not necessarily go with labeling that as a one. I might look at this as a larger degree completed wave structure. This to me is not indicative of something that's sustained even after this pullback. In fact, the fact that we've had so much overlap and kind of a labored move and then a sharp move lower tells me that I would be more inclined to be selling rallies here as opposed to buying pullbacks. I've had my eye on the 695 7 handle on dollar China for quite a while. I've traded it here and there, long it here and there, but I think we're probably near the end of the move higher as opposed to. I just think you're picking up nickels in front of a steamroller here by buying a pullback. Doesn't mean it won't work, but if you're looking for what I would consider the next bigger move, I think the bigger move's to the downside.
Yeah, well, it'll definitely be interesting to keep an eye on. I see some of your symbols that you keep an eye on over there. I was wondering if you could pull up the chart of EEM. I see you have it over there. I know it might not be one of your favorite ones to look at. Maybe it is. But if you could pull it up because it's pretty interesting, I'd be interested on your take on how that looks and what that is telling us about the future, what you'd be looking to do, if anything.
Well, we do use EEM as a barometer. In fact, we run a portfolio here, and we have a model portfolio component of the portfolio. If you let that sink in for a second. And we actually went overweight EEM, maybe about 2 months ago, not only because of the valuation levels are attractive, but we also saw that, or at least our forecast was that the dollar would begin to move lower. And typically a weaker dollar is a benefit to the emerging markets. And obviously that has not played out. Obviously EEM is higher today by about 3% simply because the dollar is lower. So we've had a lot of false breaks up. And in fact, this count's completely wrong because I haven't even been really watching it. I don't really trade EEM. I just look at it as a barometer. But until the dollar index starts to break to the downside, it's really hard to be long EEM. We've had many, many moves higher only to be flamed out. Whether or not this is the one, I don't know, but it goes back to my original dollar index argument. If the dollar index can get below 96.15, 96.09, I would be more inclined from a trading/investing standpoint to be long emerging markets. But until then, I wouldn't do anything with it. I just think you're kind of you're guessing as opposed to being strategic.
Well, I think that's a good point. And Tony Greer, who was joining us yesterday, had similar thoughts. And he actually was bearish EEM and bullish the dollar. But echoing the same exact thoughts of what you're saying, that EEM, it's really important for emerging markets to keep an eye on the currency because that's a huge picker, I guess you can say, for where that's going to go, and whether it underperforms or outperforms the S&P, things like that.
Oh, you're absolutely right. Absolutely. And that's why, again, I don't track EEM on a day-to-day basis. All I need to track is the dollar index. Because until the dollar index does something, EEM is just going to continue to do what it's going to do. Meaning if the dollar's moving higher, I know EEM's moving lower. There's no need for me to labor over monitoring another asset class. And that's the advantage of kind of being more of a macro perspective in terms of the asset classes that you monitor. Because if you know what one's doing, you kind of know what many peripheral markets are doing, and you don't have to get so hung up. Now, again, if the dollar index breaks those levels that I talked about, then I'll be getting busy on the EEM chart and saying, okay, is there an area in here that we could maybe add to a position or come up with a trading position? But until then, it's of no interest.
Yeah. What about what's your preferred instrument to look at for fixed income? Trading fixed income, is it the 10-year, 5-year, 30-year?
I just trade the 10-year. It's got to be my favorite instrument
Well,
for
on
sure.
that note, is there a way you could bring it up and tell us what you think on that one?
Yeah, I was feeling a little bearish, the 10-year notes, and we were short, and we do actually still have a small position on. We're short from 118.14, so nothing major. We're four ticks off of our entry price. Um, we got some overlap here at the 118.14, which is where I wanted to be short. My premise on this was simply that I was expecting the S&Ps to rally, a corrective rally, and we'll get to the S&Ps because we haven't talked about those yet. Um, Not really sure the S&Ps have much more in them here. I think 2740, 2800. That I think that's it. And if that's the case, and the S&Ps just go flat or perhaps even go lower, um,
Hang
that's
on though,
not going to be.
before we get to S&P though, if you could just tell me here, so you're short on 10-year, and where
Yep.
would you kind of structurally look to stop yourself out, and what sort of target are you targeting?
Well, I could tell you we've been short this for a couple of days now. The original stop's at 119.06. I could tell you that the way the market's trading today, we will not be in this trade to 119.06 because the dynamics have changed. I'm already seeing weakness in the S&Ps a bit earlier than I'd expected. And if the S&Ps continue to weaken, this trade will get cut because presumably if the S&Ps start to get hit again, you're going to see 10-year notes rally. And the fact that 10-year notes haven't sold off as much as I would have expected based on the S&P rally, that tells me that the dynamics of the trade that I was looking for just simply aren't in place. Therefore, if the S&P start to sell off, one would, again, the conclusion I would draw is that if they couldn't sell off when the S&Ps were strong, relatively speaking, they'll probably move a little bit higher and a lot quicker if the S&Ps start to sell off. So I'm keeping a really, really tight leash on the 10 years here. But my initial premise, which may play out, is to be short. We're short
Yeah.
118.40.
I'm interested, very interested to see over the next 48 hours of trading how the 10-year trades. We have non-farm payroll. Obviously the equity markets had a fair amount of volatility, but we're at an interesting inflection point. I think I'm with you. More inclined to be a short the futures, but we'll see. Typically, the 10-year futures move higher when there's significant amount of risk off sort of trading, and I thought that the fixed income held in pretty well with the equity sell off and the equity volatility. The 1 year the U.S. government 1 year yield reached the highest level since 2008 yesterday. So I'm interested to see what happens here with fixed income and the way it affects the other markets.
Yeah, to me for the last 2 weeks, I've not seen the dynamics between fixed income, meaning 10-year notes, because that's primarily where I focus. I haven't seen the dynamic between 10-year notes in the S&P market be as robust as one would have expected. I would have expected a bigger rally in the 10-year notes over the last couple of weeks. Yes, we did rally, as you can see, off the October lows, but relative to what the S&Ps did, this is a pretty muted move higher. Hence my logic for being short. If this was the best we could do, what happens if the S&Ps really rip higher? Therefore, when we had this overlap at 118.14, it was a very reasonable trade to make, and it might still be a reasonable trade. It's just not playing out. The dynamics aren't as robust as I thought they were going to be.
Yeah. And then I know you wanted to take a look at S&P. Tell us what you're thinking
Yeah.
on that one. What does the crystal ball, technical analysis crystal ball say on that one? Because it's been all over the place.
The crystal ball says reshake the ball every 5 minutes to come up with a different conclusion. So,
And also check Donald Trump's Twitter handle before you shake the ball.
yeah, it's. I think if you're trying to quote unquote make a stand in here, I think you're really challenging yourself unneedingly or unnecessarily. Um, I mean, look at just in the just since the open, I mean, we've gone from 2708 to 2736. I mean, the volatility intraday is insane. And even if you're a short-term trader, which I can do, just as easily as the next guy, because that's where my initial years were spent short-term trading. it's pretty difficult. I mean, things are moving very quickly, but as it relates to where we're going, I'm just looking at the charts and saying, if you're patient and you can give some wide stops. We went short the S&Ps this morning. I gave a couple of different ways to do it, whether you did the futures, the spiders, or do it via a put spread. I really don't think we're going to make it much above this 2740, 2786 level. I just don't. I could be wrong, but again, sometimes you just have to have an opinion, and it either works or it doesn't. Um, but I have a hard time being bullish in here. I just think too much damage has been done, and I think we'll probably move lower over the next couple of weeks. That's my take. Maybe I'm wrong, maybe I'm right, but my payoff on the options trade is 4-1, so it's a risk I'm willing to take.
Yeah, that makes sense. So where would you say that you're wrong? Where would you say that, this is maybe the move's over and we're moving back up?
Anything above 2786, certainly 2800. And I know that's a pretty wide range, but yeah, this is where I think we stall out. And we may not even get there. We may just stall out in and around here. That would not surprise me.
And
But
then if we were to get back down to, let's say we were to get back to 2600, is that someone at a level you'd look to take profit or add to your short, or, what do you think if we were to get there?
well, I'm the world's worst presser of trades that are working. That's just not my strong suit. So for me, technically, I think it would make a lot of sense to be, um, ringing the register down at 2600 if we get there, because from a technical perspective, it just measures out in terms of a lot of the way the Fibonacci and Elliott wave ratios come together. And again, I'm not trying to make a multi-month forecast here. I'm just trying to look a few weeks out. And a few weeks out to go to 2600, you could even look out a few days and be out to 2600. That's about as far as I'm willing to stick my neck out on the line at this point.
Yeah, interesting. Um, any other charts that stick out that whether it be an individual equity or individual currency pair that we haven't hit that is piquing your interest right now?
No, I'm keeping my focus even more narrow than usual, just simply because of the price action. I think individual equities in here would be very difficult given the way the S&Ps are moving, unless of course you're trading an equity that is not highly correlated with the S&Ps. So for me, between notes, S&Ps, and a couple of currency pairs, I'm plenty busy, and I feel as though I'm on top of things as opposed to scrambling and feeling spread too thin, which is not the way you want to feel anytime, but especially in this market.
Yeah, you and a number of other people have mentioned that, especially in this volatility, it's important not to be spread too thin. Especially with this volatility, all you need to do is keep your eye on 3, 4, 5 things and really know those 3 or 4 or 5 things, what's moving them, where their signals are, where their key levels are, and what you're ready to do, opposed to looking at 50 things. And with this volatility, there's enough opportunity in just a few instruments. So that's sound advice there.
Yeah, I've always been a proponent of less is more, but especially in this market. I mean, the fact of the matter is, if you're honest with yourself, you can't keep track of more than a few things and expect to be effective at it. It's just most people's brains aren't wired that way, and mine certainly is not.
Yeah, absolutely. All right. Well, thanks a lot. This is Dave Floyd of Aspen Trading. You can check out more information of Dave's on aspentrading.com. We really appreciate Dave coming on. He's been joining us for the past few weeks, and a lot of great information, technical setups, things like that. So, Dave, thank you very much for taking the time.
Hey, my pleasure, Michael. Have a great day, and we'll talk to you soon.
All right. Talk to you later, Dave.